All right, let's start. So Thursday, bring drafts of your papers. Next week's spring break, and I've got another paper to grade Friday, Saturday. So I'm not real picky. I know it says it's due on Friday, but you can have 6 days. It's a tough paper, but I do want to talk about it tonight. And then Thursday, I want to get you in teams of your banks and talk about to make sure everybody's got all the major pieces in there. So bring your drafts. You can bring on your laptop or written paper. Don't come with one paragraph. You should have a pretty substantial amount written because it's still officially due on Friday. So this is just a help document to give you some ideas of what should be in there. So you do have the intro section, which can be pretty significant. So who is your bank? That's why I recommend you might even start with their mission statement, their core values. How far down you have to go before the word risk shows up. If I were managing JP Morgan, I would have risk in my mission statement, but they don't. But do any of the banks do? Goldman Sachs may be more likely to have it because Goldman Sachs is a different clientele than JP Morgan because of just being used to be an investment bank. But where does that word risk show up? And then what's their overall process? What risks do they manage? Is it committee run? Is it board run? I was talking to Eric earlier about the board. He was saying a lot of their board members don't have a banking background. And it just seems amazing to me. How is the board supposed to take on this extra role of risk management when they don't have banking background? You're talking some really complicated entities. The committees obviously is going to be a big part of that. So I was talking earlier, how much of the committees need to cover? Well, there may be one or two really key ones that you want to focus in on, and you look at the others and kind of you might say there's some committees really focused on credit, some committees really focused on interest rate risk or whatever. Try to figure out. When I look at these banks, I think they have some committees with names that are almost identical. If I were in the bank, I'd be like, okay, who's doing what? Is it the same people on the committees? So almost all banks have an ALCO committee that's called ALCO. Do they have a chief risk officer? What does the board of directors do? What did I leave out of this list? There's actually one important thing. So, and you got the audit. So because of Sarbanes-Oxley and even Dodd-Frank, the accountants are getting more involved in this just by law. They have to, you might say, what would an auditor, an accountant know about this stuff? Well, these aren't auditors. These are auditors of large sophisticated banks. So this is what they do. They know this because that's how they're rated. If you were an auditor at Bank of America or JP Morgan, you would know bank auditing. It'd be a really distinctive thing from anything else. So really question the board. I like, Eric looking up the board members. I think that's a smart thing to do. Is there someone on the bank that has some special expertise? Or is Jamie Dimon really running the whole show and the board's just there for, or make a show? We're not doing credit risk, but you're going to do market risk, which is going to include, I call it price risk, but interest rate risk would be part of that. You want to make sure you define what the bank says it is, not what my notes say, but what does the bank say? And I think all of the banks say we define market risk as, or market risk is, and then they define it. It might be a paragraph, it might be a sentence. And then we'll talk about the measure mitigate. And then your final conclusion is just your assessment. Does it sound like it's under control? Does this bank know what they're doing? That's the hardest part because you don't really have that much of an insight. Just reading an annual report, that's really not enough. But that's what you're looking for. What's the board's knowledge? Do the auditors really know what they're doing? You're not gonna be able to tell that from your reading, but I do think they do. The committees, their incentives, conflicts of interest. You're trying to figure out what's going on. So I mentioned at USA, it was real straightforward. We had one committee and a CEO sat on that committee. Yeah, he dictated everything. So it was a very central, very much like AIG. AIG had Greenberg there forever. AIG was real unique. I think over 70 years, they had like 2 CEOs. Pretty unique firm. And Greenberg was a micromanager from the top of manager. And then he left, and what happens to AIG? They go bust. And if you talk to John Toohey, he may have an opinion on why that might be related. Do you want a micromanager? Probably not. We had a micromanager for risk. It actually worked fairly well because he kept us focused. So I'll give you some inside scoop on USA because it's on the video, but I'm retired, so I don't care. But I still remember an exec council meeting where they're talking about Greenberg and how micromanaging he was. And one of the board members, one of the execs brought that up. And everybody in the room is saying, yeah, that's just like our CEO, but no one said it. But you could tell with the body language. And the CEO goes, yeah, that's terrible. You don't want a CEO like that. And it's like, that's exactly what you're like. So he was a very micromanager. All the details have to go through him. And Greenberg the same way at AIG. It seemed to work well at AIG until he left. So it's kind of my question at USA. That guy left. What happens when he leaves? Does it just fall? So what happened to AIG is Greenberg leaves. He really was their risk management, but it was a really good process. He leaves. Everybody just assumes, well, we got to get this good process. We don't need to worry about it. And they didn't realize how much he was driving that process. So it's important. This stuff is important. So JP Morgan, he runs everything at JP Morgan. Does everything go through Diamond? Obviously not. It's too big of an entity. But how much control does he have? If the board doesn't like what Jamie Dimons is doing, what do? They could fire him. They love. Interesting to see that. I've been on boards where the board starts asking questions, and I watch the CEO and they go, "Oh, y'all don't need to worry with that." It's like, "Oh, wait a minute. That's kind of why they're here." So we assume all this stuff is working, but there's a lot of personality and conflicts, and it's really interesting behind the scenes how complex this process is. All right, so for market risk, what are the measurements? You're all going to have stress tests, and there's probably going to be 3 or 4 or 5 of them. This is going to be tough. They're going to call them earnings drawdown. You're going to see the 100 basis point shocks. Those are all stress tests. So probably you're going to have at least 2, maybe 3 or 4 of them. And they're going to be called all different kinds of things. I'll put this document out on Canvas. All of you are going to evaluate risk. Do any of your banks not have evaluate risk? It's 100%. It's a major part of banking. So are they using parametric, historical, stochastic? Most of them use historical, but you can kind of see what is their risk tolerance. It's a lot of them. I think Bank of America ones that does 5% and 1%. They do both, or 99 and 95%. And it's on a daily basis. Some of them do back testing. I think almost all of them are doing back testing now. So we say, okay, we have this VAR, but how good of a job did it do historically of identifying our risk? If it said 5% of the time, this is going to happen. If it happened 7% of the time, or that happened 3% of the time. So back testing is important. Anything you're probably not going to find this duration of assets, liabilities, and net worth. I've never seen a bank show that. They do it internally, just like you did on exam 1, but a lot of them, or almost all of them, will not report that in any way. It's tough. They may be using words like well calibrated, advanced, sophisticated, all those kind of things that describe what they're doing. But essentially what they're doing is backing into the duration by running these stress tests. If interest rates rise 1%, our net worth falls 5%, that kind of implies a duration of 5 years, just doing the math. So anything else y'all seeing on measurement that might fit in here? There aren't that many measurements. You see how stress tests is just over and over and over again. What's the downside of stress tests? Well, there's no probabilities. It's just you run a scenario, but you don't say what probability that scenario is. So you say, how much do we lose if interest rates rise 100 basis points? But no one asks what's the probability they rise 100 basis points. So obviously they're much more likely to rise 100 basis points 3 years ago than they are today. But they don't. They just do 100 basis points to see. All right. On credit risk, a lot of banks, we're not covering this on your paper, but a lot of banks use internal ratings. So if you go work at Victory Capital, they like to use internal ratings. Does that mean they ignore S&P and Moody's? No, they're obviously aware of that. I doubt they're going to say our internal rating is single A, but Moody's has them a double B. They're probably going to be leery of going that far away from the rating agencies, but some internal rating, which means they do underwriting, they look probability of losses, they do all the stuff you do as financial analysis. There's nothing special there. Stress test for credit risk shows up. This is probably the most pages in your bank's risk management section because there's a whole section for each type of loan. That's why I've left credit risk out, because it's just so massive. It's the most important risk for the bank. And I was looking at JP Morgan, right, Eric? So they had part of their value risk was a charge for credit. Even though it's on their price, they had the value at risk for credit on their VAR. So it's kind of in there. But that is part of the analysis. A lot of banks have long aging schedules, obviously. And then one thing a lot of banks do, which is really quite powerful, we may talk about this later when we talk about credit risk, is they watch the spreads of other securities. So, you have a loan to this entity and they have credit default swaps. You look at the spreads on the credit default swaps, because if they gap out, that probably the market's telling you there's something wrong with this credit. You probably want to look into it. Or if they have options on their stock, or if they have the stock price and their stock price falls 20%, you may want to look at the credit and say, okay, what's going on here? So there's other things you can look at. These other kind of stress tests, earnings, economic net worth, these kind of things, they're essentially just saying, if we price everything at market and things change, how much could we lose? It's kind of everything at fair value. So anytime you see the word economic, all they mean is let's put everything at market value. We may not have a good market value, but we're going to guess what that market value might be. And then for mitigation, for price risk, derivatives, swaps is probably the biggest one you're going to find, but you might see swaptions. Y'all know what a swaption is? It's kind of in the title. Huh?
Basically just a future.
I'm not understanding that. Sorry. Well, I'll give you the definition and say if you said it in a different way. But so it's an option on a swap. That's maybe what you said. It's an option on a swap. So you don't enter a swap, but you enter an option to be able to buy the swap. So it's kind of a strange instrument. So futures, forwards, and swaps all go together. Swaptions are kind of their own thing. They probably have a schedule in there that show you what they're doing. So I think Dylan, you were on showing me that, right? That they have a massive schedule because they're distinguishing all the accounting treatment. So FAS 133, boy, it's a nightmare of an accounting standard, but they talk about hedges and they have cash hedges and price hedges or market hedges. And they make a distinction. Are you hedging the cash flow or are you hedging the price? And you have to account for them differently. And it's just, oh, what a mess. So that may be why they have so much detail in that schedule, because of the accounting treatment. So you don't really care that much about the accounting treatment. I don't care if it's a cash hedge or a price hedge. Most finance people don't care about that. So it's more of an accounting thing, but that may be why they have so much detail. Do try to figure out though, are they using futures or swaps, or do they use swaptions? Try to figure out, what those main tools are. You might see a huge number there if it's in notional value. Notional value tells you almost nothing, because they may have $2 billion in swaps, but some of them may be long interest rates, some of them may be short interest rates. When you put them together, the exposure is almost nothing. But when you add up the notional amounts, you get a huge issue. And then correlation. This is the offset to VAR. So in the VAR chart, you should see a line that says, here's the offset. And I don't know what they're calling it. They may call it the diversification offset. I don't know. I can't remember what terms they use. But y'all seen that in your VAR schedule, that one line with a big negative number? That's the correlation effect, that all these risks don't all move to their worst case at the same time. Are y'all seeing any other mitigations? Oh, I did leave one out. Sorry. Risk limits. I don't know why I left that one out. Risk limits, just like we can't have more than X dollars in this. Pretty straightforward. That is a pretty common tool. I call it risk budget on the exam in some places, but risk limits is the more common term. We'll see Thursday night if y'all can think of some others that would be in there. I mean, you're reading all these pages, but it's not 20 things. When it gets on the banks, it's 4 or 5 things that they're doing. It's not just a massive list. On the credit side, which we're not doing, but a lot of banks do credit default swaps. The hedge credit risk, that's pretty common. Master netting agreements, we talked a little bit about that before for those swaps. If you have a swap with an entity and sometimes they owe you money, something, the net. So you might owe them $1 billion, but they owe you 800 million. So the net's 200. What the master netting lets you do is net those so that there's only a $200 million exposure. That way, if they go insolvent, their creditors don't say, hey, you owe us $1 billion. And you say, yeah, but you owe us 800. And they say, no, you pay us the $1 billion, and then you get in line with all the other creditors for the 800. You don't want that. You want to be 200 million and just be done with it. So that's what the master netting agreement. There's been some debate if these would actually hold up in court. I don't think any of them have not worked, but there's been some debate. Hey, the creditor is going to say, hey, you owe us $1 billion, get in line on the 800. It'd be interesting if that would happen. Collateral is obviously really important for credit. It's going to depend whether it's commercial or residential. Loan to value, I've heard that term before. That's a big part of the collateral. Make sure you don't loan, is a house worth $300,000, don't loan out $320,000. And then restructuring is an important mitigation tool for banks. Oh, there's risk limits. Yeah, it's in my for both list. So risk limits, risk budgets. Try to see where that is. Risk limits, you might actually even search on the word limits and see what comes up in the risk section. Loan securitization is both a credit and a price risk. So I don't know if you saw that in the market risk section, but what is loan securitization? So a bank has, $20 billion in mortgages. They're going to sell them off into the market. So they don't have all that interest rate exposure to those. So you might do a search on the word securitization. That is a mitigation tool for both the credit side and for the private market side. Man, at UTSA, boy, they securitize the majority of their loans. It's like they weren't even loaning money out. They were just like a servicing, and they're selling everything out to the market, tens of billions of dollars. So is securitization listed in the section on market risk? Do you see it anywhere? So just do a search on that to see how they count that as. So I'll say this out there if I haven't already. All right, I want to show you a paper from a semester or so ago, but I don't want to freak you out. This person got a little carried away on the introduction section, so some of you are going to panic. I don't want anybody passing out. So are y'all not want me to show it to you?
Show it. I was going to say that, yeah, it's not on campus.
That one, okay, I'll remember that. Hopefully remember to put it out there. All right, so this, I wish I could show you a really not a strong paper so you kind of see why I'm picky, but that's kind of dangerous. I tend to show you this ones I thought were pretty strong. So this is a Wells Fargo. A little too much history, but just giving you some background on Wells Fargo. Wells Fargo is interesting, and when I started my career, there was so many banks in the United States. So many banks. Banks you've never heard of, like First Chicago, Security Pacific. Have you ever heard of those banks? Texas Commerce Bank, have you ever heard of that? Nations Bank, have you ever heard of Nations Bank? So all these banks, where are they now? They've all been collapsed. A lot of them in the Wells Fargo. Have you heard of Wachovia Bank? So Wells Fargo bought Wachovia. That name may even still be around. So JP Morgan was a big one. First Chicago was a massive bank in Chicago. And then all these banks got under JP Morgan. Bank of America obviously has consolidated a lot of banks together. So there was at one time more banks in the state of Texas than the entire rest of the world combined outside of the US. So Texas is all these little bitty community banks. And that's because, there was restrictions in banking across state lines. And so Glass-Steagall went away, and suddenly there's this massive, massive consolidation of banks. So you didn't have $100, $200 billion banks back then. It was just everybody was smaller banks, and then suddenly we had these $1 trillion banks. So he's giving some of that history, maybe not needed in this paper. So they did do some quotes that kind of give management's philosophy, focus on the needs of all our stakeholders. Then the players, who are the players? Got the CEO. Some charts they probably got out of the annual report. This is a little much, giving me all this background on the CEO, but quotes from the CEO are not bad. So you certainly could go on YouTube and type in Jamie Dimon and the word risk. I don't know what would come up. Y'all want to try it? I can type Jamie. How do you spell his name? D-I-A-M-O-N-D? No A?
No.
Really? I've been saying his name wrong. He's talking about risk US. That's not what you want. So you want, what is he saying about it? So you want him talking about JP Morgan, not about banking or about the US, but can you find him talking about that? I'm amazed on YouTube, the CEO interviews that are out there that are just, really, really insightful. You get a good sense that they understand their banks and their business. So a lot from them. They do have a chief risk officer. You don't really need to bio on them, but they went overboard on that. Chief risk officers are interesting because how much power do they really have? Did they hire USAA hired a chief risk officer? I think she left because she was like, what am I doing here? What's my role? You better have some power to actually do stuff. You can't stop people from doing stuff if you're not a chief risk officer, if you're just there for show. So, what power do they ever actually have? They do have a philosophy from the risk section that you can certainly weave into this section. You want to talk about anything they tell you about processes and how things flow. There's the board of directors and their committees. These are easy to do. You can just copy and paste them in. So they've got, I don't know if this has changed. This is, I don't know which bank this is. I can't remember. Risk committee, audit committee, credit committee. So that's interesting. You have a risk committee and a credit committee, corporate responsibility committee, human resources, governance and nominating committee, and finance committee. And there's got to be some overlap in these different groups. So here's our organization of the bank itself, the players. These are probably committees here. They have a risk committee. Yeah, this is Wells Fargo. When was their crisis? This is probably a 2020 annual report. I can't remember when they blew up, but it is interesting to read a bank right before they blew up. So which bank is this? Yeah, it's interesting to read them and see what they're saying about risk before the big blow up. Market risk. Market risk is defined as a risk of adverse fluctuation in market value of financial instruments due to changes in market's interest rates. Why do they go under? Because of fluctuation in market values due to changes in interest rates. So yeah, they got it. That is a risk. That is a market risk. Interest rate risk is our primary market risk. So they recognize it's a big one and can result from timing and volume differences in the repricing of rate-sensitive assets and liabilities. Additionally, change in interest rates can influence the rate of principal repayments. So it's all in there. They've got a fairly lengthy definition. It's managed primarily through strategy involving our fixed income series portfolio, available funding channels, and capital market activities. It doesn't tell you how they manage it, but they sound like they're about to tell you that. Our policy permit the use of off-balance sheet derivatives, such as swaps, to assist in managing interest rate risk. We utilize a simulation model to perform sensitivity analysis. So what's that? The simulation models can be stress testing. Economic value of equity, what is that? We already talked about that. They mark their assets to market value, mark their liabilities market value, and I see how much that changes when interest rates change. What is NII? Net interest income. So your loan interest rates minus your liability interest rates. Under a variety of interest rate scenarios, balance sheet forecasts, and business strategies, the simulation model provides a dynamic assessment of interest rate sensitivity, which is embedded in our balance sheet. So they're telling you, hey, we got interest rate control. We're looking at it. We're assessing it. Nothing can go wrong with this bank. So interesting stuff. You notice it's not nearly as comprehensive as what you're seeing at JP Morgan. What are they doing here? Does this look familiar? Their net interest income will only fall 6% if interest rates fall 200 basis points. That's their interest income. That's it. You wish you had more than that, right? Pretty short. Your bank wasn't quite that short, was it? Probably needed a bit longer though, don't you think, after what they went through? So didn't quite get it right. So I don't know if this is pre-Wells checking account scandal or not. Went into the board in quite a bit of detail. Talk about risk committee, audit committee. A little lengthy for me, just a little much. They even pulled stuff from our class. I don't really want you to do that. I want you to stay focused on the bank, but you recognize that chart from our class notes. So here, now this is interesting in that they did interest rate risk and market risk as two different sections. I don't really think you should do that. That's a little overkill. Because your bank doesn't have an interest rate risk section, does it? It doesn't break it out as a separate one. So that's a little overkill for me, but here you definitely want a table like this in your paper. Look at what they're looking at. Here's net interest income, the NII. Net interest income generally doesn't like interest rates falling, but generally net worth goes up when interest rates fall because usually assets have a longer duration. So you lose income, but you pick up market value. So I like to say net interest income, but I also like to say net worth. I don't know what this is. Can y'all see that? There's the derivatives, interest rate contracts. That's probably mainly swaps. So you notice how they're breaking it between, well, this looks real similar to yours. You were doing Wells though too, right?
Yeah, it's the same format.
But yours was, I think it was like 3 times longer, wasn't it?
No, it's about the same.
About the same as that? All right. You see some massive, massive numbers. There's a notional. Look at that, $8 trillion in notional, but you don't know if it's $8 trillion or 3.5 one way, 3.5 the other way. So yeah. So what is this table representing? That's the mitigation. Where did they have it? Under mitigate, right? Derivatives are a mitigation technique. So you put that table there, you're trying to get a sense of what they're doing. They don't really tell you here. They just say interest rate contracts. My guess is most of it's swaps, but it's possible they do some futures. They probably have their swaptions on there as well. And then goes into market risk. Market risk is defined as, and notice the quote. So what works well is to quote them specifically. Don't quote my class notes because I don't define the market risk for the bank. What do they say it is? You could quote them and then say what I believe they're saying here or what I think is interesting here, So quote them word for word and then maybe some commentary right afterwards would be good. What are they vulnerable to? Equity markets. So the ones I've seen are fixed income, equities, commodities, foreign securities, anything else you're seeing. They may have some of the credit in there, but that's part of the fixed income. So what is it that they're measuring when they do market risk? Measurement, obviously, by risk is huge. You're going to definitely have some tables. Let's see what they call it. They call it diversification benefit. And it reduces the risk like 1/3. It's massive. You add those up, you subtract 71. There's a period in, the low, the high. You notice here they have credit as the top line. Credit is the largest risk for a bank, but interest rates is the biggest risk of the market risk. But they throw the credit risk in there as part of their value at risk. I don't want you talking about credit risk specifically, but it is part of their value at risk. What is their risk tolerance? I'll see it up there. Oh, 1% or 99%. I say 1% because I'm coming from the insurance side. So 1%. And JP Morgan's doing 5% or 95%. Does that make a big difference? You would hope it would. If it doesn't make a big difference, you're kind of wondering what kind of analysis they're doing. There they show their credit ratings, which is interesting. And then mitigate. So anything they're missing on the measurement, there's the stress test. You notice they don't have any charts on the stress test other than the interest rate one. Does your bank show any others? Does it show, why are they just showing net interest income? They don't show economic net worth. Probably because that's a much bigger number and they just don't want to show it to you. But they talk about stress tests, but they didn't actually give any charts other than that one. And then mitigate. Diversification benefit, we already talked about that. So here they're getting in this, I don't know why this second section of mitigate, what this mitigate section, it's kind of like, maybe they're kind of light on mitigate. Do we, measure and mitigate. So they really had mitigate up here on the interest rate risk. That's another reason not to separate them, because there's too much overlap. You're going to be replicating stuff. So she's talking about it, the diversification benefit. You notice how she showed the VAR chart with the diversification benefit under measure, and then mitigate is all she did was just talk about the diversification benefit. Just mention that you recognize that as a risk reducer. Talks about limits, so a little bit light. I don't know how they did on mitigate. A little bit light on mitigate. You notice measurement was like 8 paragraphs and mitigate's only 2 paragraphs, so kind of light there. She had a separate section on risk, liquidity risk for not doing that. And then final thoughts. So this must be after the blow up, because Warren was after this bank. Some interesting discussions in there. So is it too big to really fail? Could Wells Fargo go under without government bailing it out? Are they under control? Those are the kind of questions you're asking. It's clearly failed. I mean, there's some nice comments here. Clearly the bank has failed in the past from a leadership, reputation, culture, and trust standpoint. So they had the advantage that this is the bank that had just recently blown up in the news. So you can obviously say they have a problem because they had a problem. Makes it a little easier to talk about. If I were doing Goldman Sachs, I'd be talking about their Malaysia issue. If I were doing JP Morgan, I'd probably look at the well trade. Those are getting old now, a few years ago, so maybe not as important. But Hazard Bank had a big blow up in the last few years. Banks like JP Morgan and some of these other banks, they're just sitting back and watching Silicon Valley and these other smaller mid-sized banks go under, and they're just staying out of the fray as much as they can. So this is a overly strong paper, except for on the mitigation side on market. I don't think they did nearly enough there, but everywhere else fairly strong. Any comments, questions on that?
I know you didn't mean to, but just for the video, you went to liquidity and then you said, we're not doing that part. We're not doing credit.
We're not doing credit. I'm not specifically asking for liquidity either.
Oh,
I thought I said that earlier in the.
I was pretty sure it was liquidity and market.
Okay, I thought I'd taken it out, but if I didn't, I mean, liquidity is really short if you do talk about it.
Yeah.
But I thought I'd said I'm not that interested in it, but maybe I'll give y'all extra credit if you put it in there. It's not going to be much. The main problem with liquidity is there's really no way to measure it. I don't know if your bank, if you read the liquidity section in your bank, you try to do measurement, There's no, you can do stress testing, but that doesn't really tell you anything about liquidity. You find out about liquidity when it happens. That's the only measurement we have. All right. So Thursday night, we won't spend the entire class, but we'll spend a good chunk of it with you and your teams talking about your paper. So make sure you come here with your paper prepared as far as you've gone. And we'll get into it. All right, I want to talk a special topic here, one of my favorite topics. Not quite as favorite as the first exam topic, but I do like this topic. So you just saw our valued risk. Diversification reduces the risk by about a third. It's a huge risk mitigation tool. So my question is, does it actually work? So when you finish your paper, you can go read this blog. I've made this presentation to at a few conferences. It's a bit provocative to even ask this question, because in college you're just told, yeah, of course it works. So that's what everybody does. But can we ask the question? And has anyone else asked the question? So let's look at the history of this. And this is out on Canvas. So William O'Neill, pretty famous guy in risk. I forget when he passed away. I don't think it was. Again, I can't spell names. Been a stockholder in 1958. He founded Investors Business Daily. I think passed away not really that long ago, but I don't see his name anywhere in here. Yeah, that's pretty recent, isn't it? Yeah, I remember this presentation. I was making this presentation last summer. And so I want to see what William O'Neill's doing and what Markowitz are doing. So I look it up and they both just died before the presentation. And it was like, wow, I'm not going to do any more presentations with people's names in it. But yeah, both of them, I think Markowitz, let's see. Not that Markowitz. Yeah, June. So William died in May, Markowitz died in June, and so hey, I'll just go look them up, see what they're doing today. And it's like they're not doing much today. So all right, so William, the pretty famous guy, and this we're not talking about someone from the 19th century, it's a pretty recent guy. So he says diversification is a hedge for ignorance. I think you're much better off owning a few stocks and knowing a great deal about them. By being very selective, you increase your chances of picking superior performers. You can also watch the stocks much more carefully, which is important to controlling risk. For an investor, 2 stocks, 3 stocks, 4 stocks, 4 or 5, 6 or 7 stocks. So what is he arguing? Familiarity is far more important than diversification. You're far better off knowing what you have than you are diversifying a bunch of stuff that you kind of know. That's pretty radical. Maynard Keynes, he died a much longer time ago, but famous economist. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums in enterprises which one thinks one knows something about and the management of which one thoroughly believes. It is a mistake. He doesn't say, I question if it's good. He says it's a mistake to think that one limits one risk by spreading too much between enterprises about which one knows little or has no reason for special confidence. Again, they said Diversification is horrible because you can't be familiar with that many companies. One's knowledge and expertise are definitely limited, and there are seldom more than 2 or 3 enterprises at any given time in which I personally feel myself entitled to put confidence. Now, I don't know how concentrated Warren Buffett is, probably more concentrated in most portfolios. We generally today consider a concentrated portfolio to have like 20 stocks in. They're talking 2 or 3 or 4 stocks, very, very concentrated. Now, what's the difference between Keynes and O'Neill and today? Computers, digital information of, you can get to know an entity pretty well with the computer doing all the work and, doing quite a bit of analysis. So that's definitely a difference between now and Keynes. So it's a battle between familiarity versus diversification. Have we fixed the familiarity with the computer age? Especially when you talk about passive investing, where you just buy the entire market. That's something they definitely were talking about in the 30s and 40s. So what do we say today? Investment diversification, one of the basic building blocks of a solid portfolio. Diversification is the fancy name. Don't put all your eggs in one basket. It's the basic principle behind asset allocation. I don't even tell you who said this because everybody says it. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited. The practice is designed to help reduce volatility of your portfolio. The goal is to reduce volatility of your portfolio. I remember at UTSA, it really bothered me that we didn't have like our we believes. This is what distinguishes UTSA from all of our competitors. So I wanted our we believes comments. And the committee got together and they're like, well, we believe in diversification. I'm like, yeah, everybody believes that. So it's like, let's not even talk about that. They started saying stuff that everybody believes. I'm like, no, what do we believe basically? And this is one of the first things they say. Make sure you diversify your portfolio. But yeah, we can't say that's the we believe for UTSA because that's just common. Everybody believes that. I'm saying that even though I'm questioning it. So I'm like, maybe I don't believe it, but you just can't say that. Why do we believe that distinguishes us from all of our competitors? This is not something you can use as a distinguishing factor today because everybody's going to say diversify, diversify, diversify. One way to balance risk and reward in your portfolio is to diversify your assets. The strategy has many complex iterations. It's simply by spreading your portfolio across several asset classes. They're not saying securities, asset classes. It's not just having 20 or 40 or 50 stocks. It's having large companies, small companies, European companies, reducing the number and severity of stomach turning ups and downs. How did this work in 2008? We went through, man, I'm so glad it was diversified. I only lost 40% where I could have lost 48%. I don't know if that helped all that much. We'll talk about that. The promise and power of diversification is that much risk completely disappears with only a small impact on expected return. That's the idea. We saw that with the efficient frontier. As you diversify, as you add more assets, your return kind of modulates around, but your risk starts dropping really, really fast. But I'm going to ask the question in 2 ways. I got to watch time here because we lost our panel up here. So we're going to ask it at the individual security level and at the portfolio level. So your project 2, you're going to be doing this at the portfolio level. But we want to ask at the individual level. And then after I question diversification and I kick out everything you learned in college, I'm going to ask, can we replace it with something? I'm going to give you 3 alternatives, right? Or 2 alternatives. So I'm not going to just leave you high and dry. All right, the stock level. Should you have 1 stock in your portfolio or should you have 30 or 40 or 50 in your portfolio? Is there a better approach? So here's where capital asset pricing model comes in. Y'all know this backwards and forwards, right? You can write 50 pages on CAPM. So what are the 2 risks William Sharpe came up with? A stock has systematic risk, unsystematic risk. Systematic risk, that's exposure to market events like the economy, interest rates, inflation, geopolitical events. Unsystematic risk, those are those company-specific risk. Which of these does the market pay you a risk premium? Just systematic. What does it pay you for taking unsystematic risk? Nothing. Why? Because you can eliminate it just by diversifying your portfolio. I've heard that I think we teach CAPM. Can you think of a finance class where they didn't talk about CAPM? Maybe in John Tui's class. Has he done CAPM? Anybody taking John Tui? Has he mentioned CAPM?
He's touched it.
Yeah, he mentioned it, but it's not a big part of his class, right? Because it doesn't really apply. But almost every finance class, you keep getting hit with CAPM. Is CAPM important? Yeah, you better know it. I remember studying for the CFA exam. I was in this class. It's like the week before the exam, and these two guys on the front row are like, "What was that CAPM thing? I don't remember." It's okay. I think I'm ready for this exam because it's like that was like 25% of the exam was sticking numbers into the CAPM formula. It's like, okay, give me more of those questions. I can handle three numbers. So it's a really famous formula. That's a big part of finance. You want to know what prize in economics for the CAPM. Obviously, it's a good theory. How much of an individual stock's risk is systematic versus unsystematic? Well, most of it's unsystematic. 70–80% is unsystematic. Only about 20%, 30% of a stock's risk is systematic. So that means when you put 20, 30 stocks in your portfolio, you're eliminating a massive amount of risk of those individual stocks. Somewhere around 20 stocks, if you make sure they're from various industries, you're almost completely eliminating your unsystematic risk. It's not hard to do. In one phone call to Vanguard, you can eliminate 100% your unsystematic risks by buying a stock portfolio. Pretty easy to do. So here's the kind of picture of it. I took 10 companies and I combined them. So here, if you had just one company, here was its return, and here was its risk, standard deviation. Then I put two companies in. The return was about the same, but what happened to the risk? The red bar, it dropped. The green bar is the average risk of the two companies. But the red bar is the standard deviation of the portfolio. So what do you notice has happened here? The average risk went up, but the actual risk of your portfolio actually dropped. Why? Because they're not perfectly correlated. They don't move exactly together. What formula might you use to figure out that standard deviation? Anybody have a formula we could use to figure out how we got this red bar? Maybe the weight of A squared times your standard deviation. Maybe sound familiar, right? So that's that formula. And what happens when we add a third stock? What happens to the return? Not much difference, right? What happens to the risk? Now the average risk came down just because this was a less risky stock. The average risk came down, but the actual risk of the portfolio has dropped from 40% down to less than 30%. Out of four stock, the return's coming up because we're adding stocks with higher returns, but the risk just keeps falling and falling, even though and here it's interesting, right? The average risk increased, but the risk of the portfolio actually dropped and dropped and dropped and dropped. So the average risk was 30%, but the risk of your portfolio was only about 18%. That's just with 10 stocks. You can gradually reduce the risk of your portfolio just by putting. And I do believe you should diversify a stock portfolio. I'm not recommending you put all your money in one or two stocks. So how much did Warren Buffett have in Apple at one point? Did he get above 20% in Apple? I have to look into, I mean, I guess if you count Geico and Jim Reed, probably not, but he had some pretty concentrated exposures, but probably not 50%, 60% of his portfolio. So here's 10 stocks where you have 10% in each stock. And just by going from one stock to 10 stocks, you've reduced your risk from 40% to about 18%, and your return actually is slightly higher because the return is just the average of returns. But the risk is definitely not the average of the risk, is it? That's what the green bar is. The risk is a much, much lower number. If we went out about 20 stocks, we'd probably end up looking just like the market pretty closely, depending on the beta of the individual stocks. I'm not going to show you that chart. So diversification does an excellent job of reducing company-specific risk. Unfortunately, that risk reduction is not stable over time. What does unsystematic risk do during a crisis? So here's the percentage that is systematic risk of a stock. You want this to be really low. You don't want all your stocks moving together. So you want 80–90% of the risk to be company specific. And so You can see here, I mean, isn't this amazing? This was the systematic risk of those 10 stocks. Less than 10% of their risk was systematic. Over 90% was company specific. What happened in 2008 though? 60% was systematic risk. How did diversification help you in 2008? Almost not at all. Why? Because everything was crashing. It didn't matter what company specific risk was. It's like, hey, we had a good quarter of earnings. Yeah, your stock just went down 20%. Could have gone down 24, but we had 20 because you had a good quarter. Everybody was just crashing. I think Walmart was the only S&P 500 stock positive in 08. Just everything was crashing. So what does that mean? How does diversification at the individual security work in a crisis? Far worse than in normal times. What would you like it to do in a crisis? You'd like that to be the best that it does, but that's the worst that it does. You hear me say that about finance over and over again. Our risk tools in finance work really well until when? When you really need them, then they don't work very, very well. So that's the downside. I still believe you should diversify at the stock level, but just realize if you go into a crisis, your portfolio is not going to feel that well diversified. It's something going to feel like you have concentration risk. It doesn't matter if you have banks or whatever, everything's crashing. There's one bank in these 10 stocks, but there's not 10 banks in these 10 stocks. Everybody understand this chart? Now, anybody know how I calculated systematic risk? Anybody remember that? I think I mentioned in a previous class. So if you have your weekly returns of your stock and the weekly returns of the S&P 500, how would you calculate the percentage that is systematic risk? It's a real easy calculation if that helps you. Let's see if I can find an example for you. So Abbott, y'all heard of Abbott? So there's Abbott's daily price, S&P 500, their returns. The beta is 0.65, but that's not the systematic risk. That's the measure of the kind of systematic risk they have. Are they a cyclical or defensive company? So what is Abbott? Beta 0.65 must be defensive, right? But that's not their systematic. What percentage of the risk is systematic? So you may want to guess what formula that is. That'll be correlation of Abbott to the market squared. It's R squared. Y'all heard of R squared, right? How high can R squared be? 1%. How low can it be? Not -1. That's correlation, but R squared.
Yeah.
0, right? That's the percentage of Abbott's return that is systematic risk. So how much of their risk is unsystematic risk? So 24% systematic. How much is unsystematic? That's not right. But so most of the risk, 76%, is unsystematic risk. It disappears when you diversify in the portfolio. Only 24% of the risk is tied to the market. See how easy that percentage that I got is? You just get the R squared of each stock versus the market. You notice here, this is the median of the 10 stocks. So I took each stock and did their R squared to the market, and I just took the median of that. And in 1993, it dropped down to like 5%. In 99, it dropped down to 5%. And then you had the 2000 crisis, it jumped up, 2008 crisis. I don't know what it is today. I haven't updated it in a while. I should update it. It's pretty easy. R squared, it does tell you how much of the banks or company's risk is systematic, and 1 minus that is how much is unsystematic. That tells you how much diversification benefit you have in that stock. What can we say about this line, about its stability? How predictable is that? How reliable is that? It's not very much at all. I do need to update it because I'd be curious to see what happened in 2020 with this number, just to see how impactful it would have been. Here's beta. This is Walmart's beta. What do you notice about their beta? Yeah, it was a smaller company back here, and it actually went negative in 2008. It went negative. That's a great thing. So if you had 100% of your portfolio in Walmart in 2008, you would have been pretty happy because you would have made a small return. And their correlation, their beta actually went to negative 0.2, and it jumped up to 0.8 for some reason. What kind of company is Walmart? Cyclical or defensive? Obviously defensive. So their betas should be well below 1. That's what you expect. But as a small company, it's going to be higher, and then it comes down over time. But what else? What do you notice about beta? Very unstable. So not only is the amount of the stock's risk that's systematic, not only is that shift, but whether they're cyclical or defensive, that changes over time too. I mean, did Walmart, were they like selling cars here? And then they started selling rice cakes. And then right here, they decided to do big screen TVs and nothing else. And then say, no, let's go back to rice cakes. Or did Walmart do essentially the same thing the whole time? But some reason their beta kept shifting around. And why does beta shift around? Well, that's kind of, if you look at the capital asset pricing model, it kind of assumes beta as a very predictable, stable number. It's all over the place. And I think the reason it's all over the place is not that Walmart's changing, but what's driving markets is changing. So in 2000, it was tech stocks. If you were in a tech stock in the 2000s, I don't know what Walmart would have jumped up then, but if you were in a tech stock, your beta was probably low and tech stocks were high. 2008, if you're a bank, your beta was really high. If you weren't a bank, your beta was probably lower. So certain things drive certain things. And certain systematic risks dominate markets at certain times. You know, inflation, interest rates, or certain things that are driving it at different times. All right, so I believe in diversification at individual security level, but it's not the most reliable thing in the world. It's going to come back and bite you at the worst possible time. It's very unreliable in terms of your metrics because they're so unstable versus what you would expect. It's a bit frustrating, but diversify your portfolio. Don't put all your money in one stock. But what about at the asset class level? This is where academia teaches you to do this and never questions it. So I'm going to question it. Don't tell the other professors, but I'm going to question it. Does diversification work at the asset class level? This is that efficient frontier you're going to do on paper 2. Your inputs are expected return, expected risk, and expected correlation. And efficient frontier says there's some superior portfolio that has the highest return at every point of risk. And we love low or negatively correlated assets because they can greatly reduce the risk of the portfolio. So what's a negatively correlated asset? What asset does well in the US is US stocks are crashing.
Well, I mean,
What worked in 2008? Treasuries, long-term treasuries, they were up like 60%. There you go. How did they do in 2022? They were down 30, 40%. Okay, so one for one, 50%. What was up in 2008 and up into 2022? I bet you can't think of anything. You might say gold. Gold loves a crisis. Gold loves inflation. How did gold do in 2022? Not very well. Tips, maybe how did tips do in 2022? If you think inflation bonds would have done well, they didn't do well. They were down. US dollar, maybe? What did you just sell currencies of other countries? How did they do? How did the dollar do in 2008? I can't even remember. I should be able to remember. I can remember a lot from 2008 because I didn't sleep much that year. Oil did great in 2022. How did oil do in 2008? Probably not so great. So what do you notice about 2008 versus 2022? 2008 was a financial crisis, a recession. 2022 was inflation. Two very, very different things. Is there an asset class that is consistently going to protect you in both a crisis and an inflationary environment? That's where I'm going to give you the alternatives. How do you think about this differently? So if you say, hey, I'll just put my client in long-term high quality bonds because you saw what happened in 2008, what are you doing? Saying, well, I'm assuming inflation is never a problem ever again. Is that a good assumption to make for your client? So it's tough. Are there truly, and I guess what I should say here, a reliably negatively correlated asset, but there aren't any negatively correlated assets that are reliably negatively correlated all the time. So expected return, how do we get that? We're going to see that with paper 2. For bonds, I just use whatever their current yield is. So treasuries are yielding, what are they today? 5.2%. Treasuries using 5.2%, that's what I forecast my return. High yield, not so much. High yield, I'll subtract out some because some of them are going to default, but that's my return. For stocks, y'all have had me before that have had me before. Stocks give you a current dividend yield plus expected earnings growth. I actually read an economist article this week that said that exact same thing. Dividend yield, you might adjust for stock buybacks, but you're talking 6 to 8% return kind of assumption. Alternatives, who knows? It's a function of supply and demand. What's the return on nickel going to be in the next 20 years? That's a tough one to do. Or cobalt, who knows? These are really tough things to project. Currencies, how do you project currencies? It's all over the place. So who knows? Expected risk and correlation. The expectations are pretty stable over time, but the actual numbers themselves are pretty volatile. So here's a bond return. This is the average yield. And this is the return over the period. I'm sorry. This is the start. I'm sorry. So the average return for the whole period was 4.97. The average was 4.97. The return for the whole time was 4.4%. The blue line is the starting yield, and the red line is what you would have gotten in the next 4 or 5 years. So essentially, I'm saying use the blue line to predict the red line. And you can see it doesn't do a great job, but it's not horrible. So here, when interest rates really rose, bond prices fell. Your projection for bonds would have been much, much, much higher. Here, interest rates fell, bond prices soared. Your forecast would be a little bit off. But over time, the starting yield is a pretty good forecast for bonds. It's not that difficult to project bonds. For stocks, some of y'all have seen this before. The dividend yield plus earnings growth does a pretty good job of projecting stocks over time, but right now stocks are well above that line. Stocks have gotten ahead of themselves. So I should have updated this one. I have updated charts, but I didn't put it in this presentation. But the red line is the dividend yield and earnings growth for every decade. And the blue line is the actual return on stocks. And you can see for most of the time, the slope is pretty good. Here's 2008. And since then, it's just been kind of soaring up above. But I do think that's the best estimate for stocks is the current dividend yield plus earnings growth. We're not going to get into that in this class. In my investment class, we talk about it quite a bit. So I just think stocks should get you a 6 to 8% return. Tomorrow night in Investment Society, I'm going to talk about what the Economist has been writing about this recently. They're asking the question, is the U.S. stock market in a bubble that's going to burst? So I went through their 2 articles and I highlighted their negatives in red and their positives in green. There's a lot more red than green. So what are people hoping in the stock market? What's going to save the stock market? The AI, right? So AI is going to produce all these wonderful new earnings and all that kind of stuff. Who knows? In the past, what's happened? The market really hyped a particular technology. Did it end very well for the stock market? Usually, it was pretty horrible at the other end. But I do think that's a good estimate for stocks. We're not going to get into all of these. Here's the standard deviation of the major asset classes over time. So you need an assumption. This is large companies here. I'm not sure which line it is, probably this line right here. So you need assumption for your client. What assumption do you use? If you use this assumption down here, you're telling your customer stocks are not all that risky. Right before the 2008 crisis, if you use an assumption up here, you say stocks are incredibly risky, so they take all their money out of stocks right before the major rally in stocks. So what can we say about the standard deviation of markets? Very unstable, very unreliable. What is something, you just go in the middle point, halfway point, and try to forecast it, use 15%. What is this? Emerging markets, 33%, are as low as 15%, are as low as 13, 12%. Very unstable. So you got to make a forecast, but historically, risk has been doing that. It's really, really tough to figure out what risk you're going to do. Which line looks the most stable? Fixed income. Fixed income's pretty stable. Yeah, fixed income's not that risky of an asset class. It's fairly consistently not that risky. All right, so we talked about this earlier. 8 sigma days. How often should you see an 8 sigma day? Never. Right? Every trillion years or so. So in the 80s, we saw 3, all of them related to the October 87 crash. In the 2000s, we saw 5, all of them in 2008. I think some of them we saw in the same week, all in the last quarter. So this is, a few months before my retirement date. So I'm kind of glad I'm retiring because it was not a fun time to be in finance at all. Really, really rough. We saw days when the market fell 11%, was up 11%. It was just crazy, crazy, crazy stuff. So I don't know where I got the 6 trillion years from because you can't actually do this in Excel, but it shouldn't happen very often. I'm saying you should see one of these. We saw 5 of them in 2008, and then you bring 2020 in. 2020 had 3 or 4 as well. Most decades, not at all. So yeah, most decades shouldn't have any at all. But how many should we have seen in this chart? Shouldn't have seen any. I mean, maybe one freak accident, but you're seeing, 8 right there in that. So standard deviation, our measure of risk says none of these happened. And they happened. So did we see 1 in 6 trillion year events in 2008? Or is there some problem with standard deviation as a measure of risk that's understating risk in some way? Here's correlations. What do you notice about correlations? A little more stable between stocks, but still kind of bouncing around quite a bit. Here's high yield. That's not a stock, that's a bond. But what do you know? This is the key we're going to spend quite a bit of time on. Here's bonds. What do you know about fixed income? So are bonds and stocks positively correlated or negatively correlated? The answer to that is yes. The answer to that is yes. But yeah, generally we think negative, but not always negative. So when are stocks and bonds positively correlated? When they negatively correlated? Positive during inflation. 2022, what happened? Bonds dropped 20%, stocks dropped 20%. Why? Inflation. All right. So are stocks and bonds probably positively negatively correlated? And we're going to look at some people who are going to say that's the wrong question. Correlation doesn't tell you anything except for what happened historically. It tells you nothing about the future. Correlation is an artifact of environment. So we're going to hear this word environment. The key is the environment. Was it an inflationary environment? Was it a recession? Was it a growth environment? Was there something geopolitical going on? It's the environment that matters.
So I was going to say that risk measurements fail to account for human psychology.
Yeah, that's part of what Andrew Lowe's talking about in his adapted market hypothesis, is that markets change over time because people adapt to markets and they change their behavior in response to history. That's the problem with using history to forecast the future, because history changes us. The future is going to be different because we lived through history. So, it's hard to use the past. But stocks and bonds is probably the most important thing, because the overwhelming majority of Americans have 3 assets: stocks, bonds, and their house. And that's it. And what happens in an inflationary environment? their stocks and bonds are both going to blow up. 2022 was a pretty horrible year for most American investors. Because they thought they had diversification, but they didn't. That's to bring 2022, and I have to update all these charts here. Here's 2008. Large cap were down 42%, small cap down 48, developed down 44, emerging markets down 48. How did diversifying your stock portfolio help you? By asset class. What do you wish you had? Had it all in large cap, right? That would have been nice. That would have saved you 6% on the loss. Yeah, what do stocks do in a crisis? Correlations go to 1. It doesn't matter what you have. It's just going to all crash. Bonds did okay, but that's mainly treasuries. If you look at corporate bonds, they were down 15, 20% in 2008. High yield was down. A typical 70-30 portfolio was down 31%. Horrible portfolio. So yeah, it's so what can conclude about this? On the individual stock level, diversification works, but it's terribly unreliable and it works the least when you most need it. I'll come back to this next class as well. For asset classes, I'm not so sure. I think it's a little more tricky, but what do you replace if we don't do that? So we'll talk about that. We're going to look at Bridgewater and what they say about correlation. They have a pretty radical voice. And then there was a presentation at the CFA lunch where this guy made a kind of a similar conclusion that Bridgewater did as an alternative to this. So we'll come back to this. All right, I'm going to leave it there. Make sure you bring your papers on Thursday. All right, let's start. So I want to finish up this presentation. We may have to talk more about it when we get back. When we get back, we'll definitely talk about the second project. I've got that file updated and it's out there on Canvas. And it'd be supported with videos. I'm not sure I'm going to update all of the videos. So you may have some that are doing everything you're supposed to do, but like with the URL data. So you won't get exactly the same results, but we'll see. I get tired of remaking the same videos over and over again. So we'll see. All right, so we're talking about diversification last time. And tonight we're going to talk about your papers. So I'm going to leave us plenty of time to do that, but I want to get through this whole thing. So this is a big essay on the second exam. You might want to try put your thoughts down now while you're right in the middle of it. So for individual stocks, yeah, I think it makes sense to diversify. The markets have become so efficient. I don't know how anyone would be really confident to put all their money in one stock. I certainly wouldn't put all my money in NVIDIA right now. It's a great company, but boy, it's an expensive stock. Might make some sense. There's some really cheap stocks that look really cheap, but they may be going out of business. So I could make, 400% or negative 100%. I don't know who's so confident that the market is absolutely wrong on a particular stock that they're going to put all their money in one stock. The whole familiarity versus diversification, I think computers have solved a lot of that for us. Plus, indexing has proven itself to be so effective. Now, I don't know if you looked at Keynes and O'Neill, would they have beaten indexes? I doubt Maynard Keynes was all that great of an investor. Who knows? We never get those numbers, so who knows how good they were back then. No one knew what indexing was back then anyways, so you wouldn't have been able to do it if you wanted to. So familiarity and benefits concentrated portfolios, probably not a smart move today. The problem is, as well as diversification works on the security level, it doesn't work consistently, and it works the least when you most need it. During a crisis, there's a lot more systematic risk in stocks than when you don't really need diversification. It's just the negative side of finance. Betas themselves are unstable, just that whole idea of how much. So first of all, how much systematic risk, the percentage keeps moving, and then the firm's sensitivity to systematic risk changes. So all of your inputs keep moving around. So you don't have a lot of confidence. You can't just look at history and go forward. I'm not really sure. Boy, Markowitz passed away this last year. I would love to have sat down with them and asked, what did you actually do in the 1950s to come up with the standard deviation and correlation of every single security in the stock market when you didn't even have a calculator? Do y'all even know how they did things back then? Did he just have 50 PhD students and they just for all their crunching numbers? So I don't know. It seems completely almost impossible to do numbers. So my guess is they may have been using 3 years of data, 5 years of data. Just think 5 years of data just seems overwhelming. Times 500 stocks, 5 years, that's 60 pieces of data. You got to subtract each one of those 60 months by all the other 499 stocks to get, and you have to get the average. How did they do that before we had calculators? It just doesn't make sense to me. So I can see back then you had no choice but just to rely on recent history because you just couldn't do all the calculations. But now we can do those calculations and we can see how unstable those numbers are. I don't think he knew how unstable they were because he could only calculate them once. So we now know these really critical inputs for risk management are very unreliable looking at history. They change so dramatically. But I still think it makes sense to diversify at the individual stock level. At the asset class level, I'm not so convinced. Even though every financial planner says, diversify across asset classes, not everybody agrees with that. Jack Bogle, he was head of Vanguard, and he didn't believe in buying non-US stocks. That would have been really smart the last several years. But his argument was Coca-Cola, Exxon, those are international stocks already. You're getting a lot of international exposure by buying US stocks. He's ignoring the currency impact on risk and those kind of things. So not everybody believes that. But my problem in the US, as we talked about last class, most US citizens, their whole idea of diversification is stocks and bonds. And that works really well until when? Inflation. Yeah, inflation kills that. So what else do you have? We're going to talk about that. So yeah, you've got something that works really well unless inflation shows up and then you're sunk. Sounds like a pretty weak diversification theory. So correlations are unstable, and they shoot up during a crisis. So when you need that diversification the most, they help you the least. With the exception of long treasuries. Long treasuries do great in a crisis, unless the crisis is inflation. But yeah, long treasuries did great in 2008. There's times when they really do help you quite a bit. Standard deviations are unstable over time. And then extremely rare events happen a whole lot more frequently than they should, according to the math that we're using. Now, there's a whole lot of college classes. I should put this on video. There's a lot of college classes that teach this stuff like it works perfectly. And I'm not so sure about some academic professors. They don't think everybody's doing it and we're all good. That, you go calculate a correlation, that's your number. You never have to worry about how unstable it is. You just use it. I've had professors ask, Ron, why do you do the rolling beta? Some of y'all see me do that. And so you can see how unstable it is. And they're like, hey, don't do that. It kind of messes up our lectures. But yeah, I mean, we're using assumptions that are very, very, very unstable. So all of our assumptions are unstable, much more unstable than the theory allows. So you're probably asking, if we're not going to diversify at the asset class level, where do we diversify? How do we do this? So I'm going to give you some alternative solutions. And here's the one I've heard a couple of times. You don't diversify asset classes, you diversify environments. So how many environments are they? The two people who presented, one had 3 environments, one had 2 environments, or 4 environments when you combine the 2 different combinations. So I'll start with Bridgewater. Y'all heard of Bridgewater? What's his name? Yeah, Dalio. I tried to read his book, but boy, I couldn't do it. It was a little too sugary sweet. But anyway, yeah. Would y'all want to work for Bridgewater? Pretty stab in the back kind of firm. It sounds like, it's just like everybody's stepping on other people's hands and heads to get ahead. Sounds like it'd be a rough place to work, but obviously very well respected firm. So they're talking about correlations. Underlying approaches to portfolio and risk management. One of these is the consensus among approach to correlation, which we think is deeply flawed and has caused numerous problems. So here's what they believe, and what they're saying here is going against academia pretty strongly. Here, listen to what they say here. This is pretty crazy. We have a different view. We believe that correlation does not actually exist as a characteristic of an asset class. Asset classes don't have correlations according to them. Rather, correlation is just a statistical artifact reflecting how things happen to turn out. And they say provides, at least they say little, but provides little or no insight into future relationships. Historical correlations don't help you know what future correlations are going to be. That's a pretty radical statement. What is correlation? Why do correlations turn out how they do? Correlation is simply how two assets return correlate with one another. Understanding correlations require understanding what's causing those things to move. And they don't move the same in every environment. We've already seen that with stocks and bonds, which is the most important correlation of all. Stocks and bonds. That's usually your single most important decision. And that's changes under different environments. And so how do they assess it? So they have growth environments. Growth environments, those are really good environments where the economy is doing well, everything's cooking. They have an inflationary environment. They have the risky environments. And what they're saying is under these different environments, asset classes have different correlations because of that environment. And so they have their model, which tries to look at risk premiums, and they say their model matches much better than the traditional approach. You can look at kind of how they think their different models do underneath these different environments. I'm going to show you the second approach, which I think is a little easier to understand. But so essentially, there's growth, inflation, and risk. Growth environments, stocks love it, bonds don't like it. That's kind of like the 90s, right? In the 90s, well, bonds did okay in the 90s because interest rates were still falling. But a growth environment, you want to be in stocks. I mean, bonds did okay in the 90s, but you'd much rather make 12% a year than 7 or 6% a year. That's a good growth environment. A risk environment, boy, you want bonds. If things are blowing up around the world, you got recessions, boy, you want bonds. So in 2 of the 3 environments, stocks and bonds are negatively correlated. And then in inflation, stocks and bonds are positively correlated. In the 80s, 80s and 90s, it was hard to lose money in the 80s and 90s. That's when I started my career. Is like, I remember just watching my 401k plan. Oh, it's up another 5% this week. Oh, it's another 6%. It was just like, we just thought that's the way stocks were supposed to. We actually, I mean, it's crazy to think. We actually had our long-term expected return on stocks at like 13%. Which just seems so ridiculous now. But we're so used to this high inflationary environment, 13%. Wow, we're going to get that. But you just couldn't lose money. Why? Because inflation was falling from the highs of the 70s. Interest rates were falling. Everything was doing great. That was a time when stocks and bonds were actually positively correlated, but at a good time. Everything was going up. And then you had the 70s and you had the 2022 when you had inflation. Everything was going down. Stocks and bonds were both getting crushed. So you have the article from Bridgewater. You can read through it. It's not that difficult an article, but I'm going to do this guy. I don't remember his name. He was a retired guy, even older than I am. And he was going around the country presenting his idea because he thought it was really great. And he was worried, I think, that he's going to die and people are going to forget about it. So he wanted people to use this approach. So he has 2 things you look at, which creates 4 environments. Currencies, and here he's really talking about inflation. Currencies can be strengthening or weakening. What does inflation do to a currency? If you have unexpected higher inflation, what does the currency do? It's going to fall. It's going to weaken. All right. So, and he says it's really simple. You can measure that by the change in gold prices. He says gold prices predicts that in advance. So not only does he have four environment, or really two environments, but four scenarios, but he says there's a really easy way to predict them. Gold prices is one. The second one is risk. Is risk increasing or lessening? And he says you only need one statistic for that, and that's bond spreads. Very simple model. And he presented some charts I found a little unbelievable. I would have liked to have retested them, mainly because his argument was it's incredibly predictable. Gold tells you 6 months in advance exactly what you should do. Bond spreads tell you 6 months in advance exactly what you should do. You should just move all your money and you'll make a lot of money. That was his argument. So, and his asset classes were really limited: US bonds, US stocks, gold, and real assets and foreign assets. The reason he says foreign assets is essentially you're covering for inflation in the United States, so you get the currency impact. So I've just read that one. So here's this guy's approach. You have risk is increasing and inflation is not an issue. Bonds are great. That's like 2008. Dollars doing okay. Everything's crashing. Treasuries are a great place. You can really protect yourself a lot. Increased anxiety and inflationary issues. Gold loves that. Go buy gold. Just put it in the safe deposit box. Watch the whole world crumble, and then you have gold. Down here, you have risk is falling and inflation is not an issue. Stocks are a great place to be. Over here, risk is not an issue, but inflation is an issue. That's from real estate. And he doesn't mention other commodities. I'd probably put them in there, but foreign assets would work well. So he has four scenarios, and here's why he looks at the excess return. So if the economy is accelerating, stocks do great, bonds do poorly. Gold doesn't like that. Gold doesn't like good news. Gold just loves bad news. But commodities do okay. Here he says real assets. So yeah, think commodities there, but ignore gold. It gets a little confusing. So you got gold, but you got all the other commodities. Commodities love good environments. They love inflation as well, but they also like strong economies because copper and steel and all that goes into productive assets. If the economy is slowing down, stocks don't like that. Commodities don't like that, but bonds and gold like that. So the question is, if all you have is stocks and bonds, it looks like perfect, no problem, right? But then you go into the inflationary environment. What do you notice about stocks and bonds? This is the strong, weak economy. Stocks and bonds are a great diversifier, aren't they? But when you get into the inflationary environment, what happens? You lose all of your diversification benefit. So what he's saying is you need something that on each one of these lines has a plus sign. So here, strong economy, you got stocks that do well, but bonds don't. Weak economy, stocks don't do well, but bonds do. All right, so you got it. But when you come here, what do you need? You need gold and you need commodities. And then there's also times, if you look at gold and commodities, I mean, look right here, gold and commodities, what does their correlation look like on that page with inflation? They look negatively correlated. But how are they correlated in a strong economy? Negatively correlated. So he says in every scenario, you have a plus and a minus that you can combine together. You notice he's not saying anything about correlation. Why? Because the correlations change in these different environments. So when you say stocks and bonds are negatively correlated, you say, yeah, and in this type of environment, they are. All right, so if you could combine all of these together, you would have a portfolio that is positive you at least have one portfolio, probably two portfolios that are positive in any scenario. Now, what does this imply about asset allocation? See, actually saying put 25% of your money in each one of those. And that's where the shocking part of his presentation was. He's not even saying that. He's saying that sometimes put 40% of your portfolio into gold, which just seems absolutely crazy to me. I don't know anyone that would do that, but that's what he's saying. If gold is telling you inflation's a problem, currencies are going to be weakening, then you should stick a large amount of your money into gold. It's a pretty shocking. I didn't put that part of his presentation in here because it kind of scared me, but I did put his entire presentation out there on on Canvas if you want to look at it and see his numbers. They're pretty scary numbers. So their recommendation is both Bridgewater and this gentleman whose name I don't remember. Both the recommendation is forget about correlation, think environments. You need something that is going to do well in every environment. And they both have very similar types of environments. Inflation's a key in both of their analysis. It's just how do you break up the strong or weak economies. He says this is also true when you go international securities. If you look through here, these are stocks, bonds, gold, and commodities. Here, when you have inflation, which you can measure with gold, you can see stocks and bonds are positively correlated. When you have risk, stocks and bonds are negatively correlated. You can see through here, you need all four of these asset classes to cover you in every environment. If you only have 3 of the 4, there's going to be some environment where you're going to lose. Does this make sense? This is just the international side. So they definitely disagree with Jack Bogle, doesn't really get out into these other asset classes. They say you need these other ones. So my biggest question with this presentation is, do you really have the guts to put that much into these other asset classes? Put 20, 30, 40% in the commodities and in the gold. And if you did that, especially with gold, you'd be really, really disappointed in some decades where gold just doesn't move at all and everything else is shooting up. You're going to be pretty, pretty upset if that happens. Any questions on that? I gave you the presentations. Forget how lengthy of a presentation it is. This was a CFA luncheon. I haven't been to a CFA luncheon in so many years. COVID just shut me down. So here's a PDF of their entire presentation. See how many pages? 23 pages. So it's a lengthy presentation. There he is, David Ransom. I should look him up, see if he's still around. This was back 8 years ago. So wouldn't you love to see an update of his presentation? I remember at the time he presented it, what he was saying you should do, and then 6 months later, thinking back on it, I'm thinking, man, that wouldn't have worked very well. So, but he was telling us, man, it's really, really, really predictable. Let's see if he shows some, help seeing some of those charts. He's got some really, really interesting charts. Where he shows, man, look at that, between bonds and commodities. Not the type of efficient frontier you're used to, is it? Looks a little unusual, but here he's talking about how much to have in gold versus stocks. And he's said, what is this telling you here? That he has his charts. He must be an actuary. He has his charts flipped between return and risk, but he's essentially telling you 30% is the least you would ever have in gold. But you could have as much as 100% in gold. So you can see 30%. At USA, we would never recommend 30% in gold. That would just be so crazy. But I saw that chart already. So he's got a lot more in his presentation. I'm not so sure if you went through his presentation, it would make sense because he was explaining these charts, and I don't think they're standalone charts. So you might find it a little bit frustrating, but it looks interesting, doesn't it? So what I used to do these presentations is I'd bring them back and I'd go to my staff and I'd say, let's see if we can replicate this. So that's always my first thing. Let's see if we can replicate it. Let's just make sure they don't have math errors in their numbers because it looks interesting. It was convincing. Let's go try it. I've seen a few other presentations where they say, hey, if you just look at utility stocks, you can predict everything. It's like, well, that sounds interesting. Let's try it in all these different environments and see if that's true. So these are interesting things. What he was talking about, I thought was so amazing was how simple it was and how easy it was to get the data. All you needed was gold prices and corporate bond spreads. If you had those two things, you could do his entire model and retest it. So that was pretty cool. But anyway, So asset returns relates closely to the way an economy behaves, its rates of growth and inflation. The key to asset allocation is to choose assets toward which capital is beginning to flow. So he's saying if you use gold prices and bond spreads, you can decide where to put your money and avoid these major upheavals. Financial markets issue signals which motivate and guide the direction which capital chooses to flow. As a result, market signals such as credit spreads and currency fluctuations, he says currency fluctuations, he really means gold, have predictive power for the price performance of assets and growth of it and inflation. Assets can be classified according to the direction and sensitivity of the response to those market signals. Two market signals, spreads, and the gold value of currency define our four economic scenarios and therefore four primary asset classes. Predictive success is found not only in the US, but around the world. The product is a simple structure for, and that's the one thing that I love that. I love simple. If I don't understand their formulas and I can't replicate it, it's not interesting to me. And this is kind of the funny thing about his presentation. You would think he's presenting that, hey, you really like this, come give us your money and we'll invest it for you. But that's not what he was saying. He was saying, hey, go home and try this on your own. That's pretty cool. So it's the stock market sectors and styles, foreign markets, currency. There's all kinds of things you can do. So interesting. This is why you read the Financial Analyst Journal. You read the Portfolio Fixed Income. You're looking for these ideas. My approach is if the first sentence makes no sense to me, then I'm probably not going to read the article. If I decide, my IQ is too low for this article, I'm not going to waste my time. I'm not going to force myself to go through an article where I don't understand half the words in the article. But stuff like this, yeah, it's really interesting. Read it, think about it. What are they saying? Usually I start with the abstract and then go to the conclusion, see if there's something interesting there. It's got to be usable. There's a lot of articles in Financial Analyst Journal where you say, well, that's an interesting theory, but I can't do anything with that with money. It's just not practical. But here he has something very practical. It's something you could replicate pretty easily. He's saying it's extremely predictable, very reliable. It will save you a lot of money, a lot of risk. That's interesting to me. Go out and test it, see if it works. And then when you test it in different environments. How did it do in an inflationary environment? How did it do in a recession? How did it do here over different periods of time? He tested it in sample and out of sample. His out of sample was to try it overseas and see if it worked with foreign markets. That's a good way to test your models. If it works in the US, it should work overseas. There's no reason why you'd have some radical difference in the way investors react. So I love these kind of things. I should get back to the CFA luncheon, but I haven't been there in a while. All right. So what is my last solution? And that's options. I think options can play a role in risk management. So what is an option? Call option, put options. Have y'all had some of that in your class history, maybe? What's a put option? The right to sell something at a given price. What's a call option?
The right to purchase something.
Right. Which of those is risk reducing? You own a security already. Buying a put is like buying auto insurance. Okay, did you know auto insurance is a put option? It gives you the right to sell your car back to the insurance company. And when would you do that? When you total it, right? You wouldn't want to do it any other time, but the insurance company is giving you an option. They say, hey, we'll buy your car back at actual cash value if you total it. If you total it, say, hey, I'm buying my car, actual cash value. That's an option. Do you pay a premium for that option? Every month. Probably pretty hefty premium because you guys are, especially the Jews that are male and under 25 years old, you're paying a pretty big fortune for auto insurance. So options, especially put options, is our approach to how to manage risk, because you have the right to sell something to someone at a fixed price. So you know that fixed price is your worst case scenario. You might have bought it for 100, but you have the right to sell it at 90. You know the most you're going to lose is 10%. You can't lose any more than that, but you have to pay a premium for that, so it has a cost. So this is my approach for old people, not for young people, right? So for your grandparents or whatever. So the question I like to ask, I bet your grandparents have homeowners insurance. Any of y'all have grandparents that don't have homeowners insurance? Probably not. Why do they have homeowners insurance?
Or in case something bad event happens to the house or someone gets injured on the property.
Yeah, liability, someone gets injured. Their biggest risk is probably the house, right? Because liability size is not as big on homeowners. How much thought did they put into that? They're paying probably a couple $1,000s a year for that. Is that a good price? What analysis did he do to figure out that was a good price? Maybe they called 3 insurers. Right, so they got a $500,000 house, and without even thinking about homeowners, I bet they didn't have a debate, did they? So, hey, we're gonna buy homeowners this year. This year I don't think so. I think we're okay. They just did it. It's automatic. All right, and then you go to your grandparents and say, hey, you have a $500,000 stock portfolio. Are you gonna insure that? What are they gonna say to that? What do you mean insure it? So why do they insure their $500,000 house, but they don't even think about insuring their $500,000 stock portfolio? Which of those has a higher probability of falling 30% in value? So stock portfolio. So which one's riskier? Stock portfolio. Which one do they insure? The house. Does that make logical sense? Are they going to say, yeah, but the stock options are too expensive? Have they done that math? Your grandfather, oh no, man, stock options are way too expensive. I can buy home. Has anyone done that math? Doesn't it make sense if you have 2 $500,000 exposures? This one's more likely to fall than this one. I'll insure this one, not insure this one. Does that seem like a logical thing to do without any analysis whatsoever? It may make sense with analysis, but does it make sense to make that decision with zero analysis whatsoever? But your grandparents have what? What percentage of your grandparents have done zero analysis of that question? I'm guessing 100% unless, one of your grandparents is Bill Gross. I'm going to finally remember his name. So it's unlikely they have. So here's the analysis I like to do with your grandparents. Well, your grandparents may be too young. So maybe your grandparents. How old are your grandparents? Are they in their 70s?
They're not alive.
They're not alive. The ones that are alive, 70s maybe. So your grandparents could be in their 50s or 60s. So they may not be quite old enough. But if they're in their 70s, let me show you how I think about their risk. This is more for them than for you. So let's say they're going to do a 40-60 allocation, 40% in stocks, 60% in bonds. And you expect stocks to make 7% and bonds to make 3.5%. So if you do the math, 40% plus 60% of that, you get an expected return of 4.9%. What if instead of doing that, they put all of their money in stocks? Their expected return would be what? 7%. Which leaves them an extra 2.1% to buy insurance. Is it possible they could put 100% in stocks and use the option market to spend 2.1% and come up with that same 4.9% expected return, but with less risk? Is that possible? Have your grandparents done the math on that yet? So that's my question. Can the option market give us a return equal or higher to what you can do with stocks and bonds, but with less risk? And here, the definition of risk, you have to be careful. Is the definition of risk standard deviation? I'm going to say no, because what does standard deviation assume? Nice normal distribution. What do options do? They cut off the tail. So would you rather have a lower standard deviation or a max loss of 10%? You can't lose any more than 10%. I like having my most I can lose is 10%. If I'm 70 years old and I'm living on this money for the rest of my life, I like the idea that I've got a 4.9% return expected, and the most I can lose is 10%. I kind of like that versus 4.9%, and I could lose 15, 20, 30% in a year like 2022 when inflation's taking off. So I call it my hedge bucket. There's been quite a bit of analysis on these, and there are people who believe there are option strategies that are quite strong. The problem is option prices change so much that you're going to have to recalibrate it pretty constantly to make sure it still makes sense. There are times when option prices are so ridiculously low, and it wasn't that long ago we had that, where the math here is just overwhelming. You're far, far better off doing the option strategy because the insurance is so cheap. There are other times when the insurance is so expensive, you may have to rethink the strategy. But when I do this with leaps. So you're going out with options like a year or more. And so you can tell your client for the next 18 months, the most you can lose on this portfolio is 10%. You can't lose any more than that. That's kind of a nice little guarantee to give them. I'll show you some numbers next class, not tonight. So yeah, we won't get into numbers. So I'm going to show you these. I'm not saying go home and do this for your grandparents, but you should think about it, because what happens if we get another 2008 and they're moving into your garage? Is that what you want, or would you rather make sure they're? I mean, like I said, your parents' retirement plan might be you, so you might want to figure out what the probability. Maybe not the probability they lose 20 or 30%. Maybe it's the probability they move into your apartment or into your garage or wherever you have space for them. So when you get to be retired and you no longer have income coming in, that downside risk really changes, and it's worrisomeness.